While Wall Street traders are glued to 6 monitors, losing sleep over every candle flicker, a quiet group of investors is becoming wealthier by doing absolutely nothing. We analyzed a decade of data, and the results are shocking. Simple automation consistently destroys the most advanced technical analysis. Stop letting your ego drain your bank account through fees and volatility. It is time to choose the strategy that actually wins. What if I told you that 95% of professional day traders fail to beat a basic automated script over a 10-year horizon? This isn't just theory. We are breaking down the hard numbers that prove mechanical consistency outperforms frantic high-frequency trading. Learn why your complex charts are actually your biggest liability and how dollar-cost averaging turns market volatility into your greatest financial advantage. Your desire to outsmart the market is the very thing keeping you broke. Most investors crumble under the weight of over-analysis. Yet the secret to massive wealth is surprisingly boring and completely automated. We are comparing active strategies against disciplined compounding. It is time to fire your inner trader and start building a portfolio that thrives on peace of mind. Section 1. The hidden cost of being smart. We start by contrasting the high failure rate of professionals against the steady rise of index-based DCA. Even with advanced degrees and institutional tools, the majority of professional traders cannot beat the S&P 500 over any meaningful time frame. In contrast, index-based dollar-cost averaging removes the need for alpha entirely, capturing the broad market's inherent upward bias. Analyze why human psychology and the ego lead to overtrading. We are wired to react, not to wait. During periods of high market volatility, our biology screams at us to take action that often results in buying high and selling low. This behavioral gap is the primary reason active traders underperform. They are battling their own instincts as much as the market. Now, we set the stage for a 10-year data showdown between the frantic active trader and the automated investor. Section 2, the math behind the momentum. Let's reveal a decade of performance data comparing technical analysis against simple monthly contributions. Over the last 10 years, the DCA portfolio consistently maintained its trajectory, while the active trader's returns were eroded by timing errors. We must factor in the silent killers of wealth. Brokerage fees on high-frequency trades can eat up to 2% of annual returns. Then there's the massive impact of short-term capital gains taxes and slippage, the hidden gap between your intended and actual trade price. These small percentages compound over a decade into a massive difference in final portfolio value. The trader is starting every year with a handicap. Removing decision-making from the investment process isn't just a mathematical advantage, it's a neurological one. By automating, you save your cognitive energy for other areas of your life rather than wasting it on the stress of the next trade. But the math is only half the story. The technical environment has changed fundamentally in the last few years. Section 3, the technical analysis trap. Explain why 2026 market algorithms move faster than any human can react. Modern trading is dominated by high-frequency algorithms that can execute thousands of orders before you can even click buy. Traditional chart patterns like head and shoulders are now exploited by these bots before they even fully form on your screen. This leads to extreme exhaustion and burnout. Most professionals realize they are fighting a losing battle and abandon complex strategies. The data shows a massive drop-off in professional active traders after just 3 to 5 years. The stress isn't sustainable. Instead of intensity, focus on the power of time-weighted returns. It's about staying in the game, not winning every round. Mechanical consistency beats intuition because it never gets tired, never gets greedy, and never gets scared. This brings us to the most powerful force in finance, the ability to do absolutely nothing while others panic. Section 4, the compounding power of doing nothing. Visualize the growth of a DCA portfolio during major market dips. When the market dips, your automated script doesn't panic. It simply buys more shares at a lower price, lowering your average cost. Active traders often exit during these periods to preserve capital, missing the very moments that define long-term wealth. By staying in, you capture every single day of the recovery. Missing just the 10 best days of a decade can halve your total returns. Active traders are often still waiting for confirmation signals when the market has already moved 20% off the lows. This is lifestyle alpha, the value of your time. Automation requires 0 hours of weekly maintenance. A strategy you can maintain for 10 years is infinitely better than a perfect strategy you quit after 6 months. Now that you understand the why, let's talk about the how. Setting up your own system is easier than ever. Section 5, building your bulletproof system. Provide a roadmap for setting up a modern automated contribution schedule. Current 2026 fintech tools allow for fractional shares and recurring investments with 0 commissions. Choose a platform and set it. The hardest part isn't the setup, it's the mindset shift. You must learn to ignore financial news cycles that profit from your fear. Switch your focus from daily fluctuations to your 10-year horizon. If the news doesn't matter in a decade, it doesn't matter today. Conclude by choosing the strategy that prioritizes peace of mind and guaranteed market participation. Discipline is your superpower. Market participation is the only guarantee of wealth. Active trading is a gamble. DCA is a commitment to your future self. Fire your inner trader today. Set your automation and go live your life. Thanks for watching.